associated with issuing long-term debts. And then 2, we should also be able to identify various types of bond issues. There is a difference between the types of bonds and the types of bond issues. Number 3, we should also be able to describe the accounting valuation of bonds at the date of issuance. So at the date at which we are issuing the bonds, we should be able to value the bonds. Remember, we have said that now specifically for this unit, we will be dealing, for this topic, we'll be dealing with the bonds. And I hope you have already downloaded the PVIF table, the present value interest factor table. It is next to the big blue button because we are going to use it in this lesson. And I hope you have already downloaded it so that it assists us in our lesson. Remember, our lesson is also being recorded, and it will be available at the end of the class, so you can be able also to watch it later. I will be taking attendance both during the live session and also during the discussion forum. So please ensure that you contribute during the discussion forum, because the assignment or the exercise that I'll be giving in the discussion forum, I'll also be, it has got an input in our overall assessment. There is a mark that I'm allocating to it. So if you don't contribute, it means that now you will be getting a 0 in every discussion forum. So please be contributing. So after the live session, we'll go to our discussion forum. So I want us to begin by looking at the long-term debt. Long-term debt. Now, our consists of probable future sacrifices of economic benefits. It consists of probable future sacrifices of economic benefits arising from the present obligations that are not payable within a year or operating cycle of the business. So in simple terms, what we mean is that these are debts that are repaid over a long period of time, and mostly it is usually after 1 year. It is usually after 1 year. So the first type that I want us to look at is the bonds payable. The bonds payable as our first type of the long-term debt. So we can have the bonds payable. Bonds payable as our long-term debt. Now for the bonds payable, payable, bonds are usually the most common type of the long-term debt on the company's balance sheet. And the main purpose of the bonds is to borrow for the long term when the amount of capital needed is too large for one lender to supply. Now, if maybe a an organization issues bonds in 100 shillings or even 10,000 shillings denomination, a large amount of long-term indebtedness Yes, hello. I hope now you can hear me. Hello. So maybe if you can hear me, please just say yes and in the poll there so that we can continue. Sorry for that slight problem. Okay, so I think most of you can hear me, so we can saying that if you issue bonds in a small, you issue the bonds in small denomination, then now you can, people are able to participate in the loan and you're able to get the amount that you require. Now, a bond arises from a contract that is known as the bond indenture. It arises from contract, a contract that is known as bond indenture. You can just note that. Bond indenture. That is the contract. Arises from a contract that is known as the bond indenture. That is known as the bond indenture. And now this indenture will contain a promise to pay one, a sum of money at a designated maturity date, and two, a periodic interest at a specified rate on the maturity. And that maturity amount is what we usually refer to as the par value, what we refer to as the par value or the face value. Par value or face value. So that is the amount at the maturity date of the bond. Remember, the maturity date is always agreed upon by both the investor and the company or the person who is issuing the bonds. So that will be the par value. Now, a paper certificate evidences individual bonds, and the bond interest payments are usually made on a semi-annually basis, although the interest rate is generally expressed as an annual rate. So the interest rate is usually agreed upon at the end of the year. So we get the interest at the end of the year, but it is paid on a semi-annual basis. Semi-annual means may after 6 months, half a year. Now, the entire bond issue may also be sold to an investment banker. It may also be sold to an investment banker who acts as the selling agent, in the process of marketing the bonds. So you can also sell it to an investment banker. Now, in such an arrangement, the investment banker may either underwrite the entire issue, by guaranteeing a certain sum to the corporation, and therefore taking the risk of selling the bonds for whatever price that they can get, or they may also sell the bond issue for a commission. May sell the bond issue for a commission to be deducted from the proceeds of the sale. Now, alternatively, the issuing company may also choose to place privately a bond issue by selling the bonds directly to large institutions without the aid of an underwriter. So that is what we call private placement of the bonds. Private placement of the bond. So they can write it directly, privately, to very large corporations. Like in Kenya, we have Safaricom is a large corporation. We have maybe KCB, so you can sell to them directly, privately, or you can use an underwriter to help you in selling the bonds. So that is how you can sell the bonds, either privately or maybe publicly through the underwriters. So that is how you can decide to sell on the bonds. Then next, I want us to look at the accounting for bond issues. Accounting for bond issues. So how do you account for the bond issues? Remember, we have said that the types of bond issues are not the same as the types of bonds themselves. We have different categories of bonds, and we also have got various ways in which you can issue the bonds. So let us look at the accounting for bond issues. Accounting for bond issues. Now, you can issue bonds in various ways. For example, we can issue the bonds at par value. At par value. Par value simply means the face value. Or you can also issue the bonds below the par value. And if you are issuing the bonds below the par value, that means that you are issuing the bonds at a discount. You are issuing the bonds at a discount. And also, you can also issue the bonds above the par value. And if you are issuing the bonds above the par value, it means that now you will be issuing the bonds at a premium. So we have three ways in which we can issue the bonds. The first one is par value. Then we have issuance of the bonds at a discount. And lastly, three, issuing the bonds at a premium. So those are the three ways in which we can issue the bonds. So let us start with the first one. If we are issuing the bonds at par value. Par value. Issuing the bonds at the par value. So now in this case, when you are issuing the bonds at par value, these are bonds that are issued on an interest date, at par value, and no interest is accrued. No interest is accrued. There is also no premium, and the discount also does not exist. So the accounting entry that is made is simply for cash proceeds and the face value of the bonds. That is the accounting entry that is made. So we can look at an example. So assume that XYZ company, issued XYZ company issued an 800,000 shillings. I hope your calculators are ready. Issued an 800,000 shillings. 10%. So issued 800,000 shillings, 10%. 10% 10-year term bonds, 10% 10-year term bonds, 10-year term bonds. So the time period for the bond will be 10 years at 100. At 100. So that is the way that question is, at 100. So if we are told at 100, then it means that now it is at 100% the face value. So the date here was 1st July 2017. 1st July 2017. We have 1st July 2017 with an interest sorry, the date here, this is not July but January. Sorry for that. 1st January 2017. 1st January 2017, and we are told that the interest is paid semi-annually on January 1st and July 1st. The interest is paid semi-annually on January 1st and July 1st. Full stop. We are told that the accounting periods for the company ends on 31st December. So the accounting period for XYZ company ends on 31st December. That is when the accounting period ends. And remember, we are told that the interest is paid in January and in July, so 2 times in a year, semi-annually. So we are required to prepare the books of the issuing company. Prepare the books of the issuing company. So the issuing company here is XYZ Limited. That is the company that is issuing the bonds. So remember, the bond is issued at par value. The bond is issued at par value. And the amount that the company is getting is 800,000 shillings. 800,000 shillings. The interest rate on the bond is 10%. The interest rate is 10%. So somebody is asking if I can type the question. We can just typing. It will take a lot of time. So maybe we can just continue. I'll provide the question later. You don't have to worry. I'll provide it later. So we can continue. So we are told that XYZ company issued 800,000 shillings, 10%, 10-year bond at 100. And I've explained that if we are told that they are issuing this at 100, then it means that now the face value is 100%. And this was dated 1st January 2017. And then we are also told that the interest is paid semi-annually on January 1st and July 1st. And the accounting period for the company ends on 31st December. This is the whole information. So we are told to prepare the books of the issuing company, prepare the books of the issuing company. So I want us to solve this. So first of all, I want us to note the transaction that happened on 1st January, when now the company was selling the bonds. So when they sell the bond, in return, they are getting the cash, which is amounting to the 800,000. So we can have 2017, then we have January 1st. So to record the transaction that took place, we will debit cash. We will debit cash. Here I can just debit cash. And the amount there is 800,000. Debit cash 800,000, and then we credit bonds payable. Credit bonds payable, the same amount. Bonds payable, again 800,000. So that is the transaction that we will make when you are issuing the bonds. And then you can note there in bracket that this represents the issue of 10% bond. 10% 10-year bond. Issue of 10% 10-year bond. So that is the transaction that we'll make on 1st January. Issue of 10% 10-year bond. So because we are debiting cash, because when they are issuing the bond, they'll be getting the cash. And then a bond is like a loan. It's like a loan that now you are getting from another person or another financial institution. So when you receive the loan, you will debit your cash or your bank, and then you credit now the name of the creditor. So that is the first transaction. Now, when the first semi-annual interest is paid on the bond, then this semi-annual interest will also have to record it. Remember, we have said that the bond is paid on a semi-annual basis. So maybe if I can put the question to you, when will be the first time that the interest on the bond will be paid? When will be the first time that the interest on the bond will be paid? Remember, we have said that the interest is paid on a semi-annual basis. So if this bond was issued on January 1st, then the first time that the interest will be paid will be July 1st. So we also have to record the interest that will be paid in July 1st. Remember, the interest are paid on January and July, but this bond was issued on January 1st. So there is no interest to be paid in January 1st, 2017. The first interest will be paid in July 1st, 2017. That is the first time that the interest will be paid. So now to record the transaction on July 1st, we have to first of all calculate the interest. We have to calculate the interest. Remember that the 10% interest, that is an annual interest. So the semi-annual, we will calculate the 10% of the entire interest, and then we divide it by 2. So what we can do, first of all, to get the interest, now we can have 800,000, which is the par value on the bond. So in bracket, 800,000. Then we multiply this by 10%. So 10% is like 0.1. 0.1. Then this interest is the interest that is supposed to be paid for 1 year. So if we want to get the interest that is paid in a half an year, so we'll multiply now the product there by half, and that will give us the interest that we are expecting to be paid in July. So 800,000, if you have your calculator, please. 800,000 times 10%, which is 0.1, then times half. So if you multiply this well, then what will be the product there? Okay, I'm free 40,000, Prudence 40, so this will be 40,000. Okay, so that is the interest that we are expecting to be paid in July 1st. Remember, the person that is paying this interest is XYZ Limited. They are paying it to now the people who subscribed for their bond. Now, once we have determined this, we need to make the accounting entry. So because the company is paying, it means that now we are spending cash. We are spending cash, and therefore, remember, cash has got a normal debit balance where the increase is debited, but the decrease is credited. So what we will do, the accounting entry to make is that now we will debit the bond interest expense. We debit bond interest expense. Just in short, bond interest expense, the amount there is 40,000. And then because we are spending cash, our cash will decrease. So we credit cash, the same amount, again 40,000. 40,000. And we are doing this because this is now the interest that was paid on bond. So we can put there in bracket paid interest on the bond. Paid interest on the bond. So we have already now determined that at the end of every 6 months, the interest to be paid on this par value bond will be 40,000 shillings. So that is the second entry. The other entry that will be making will be now at the end of now 31st December 2017 again. Now at the end of the year, the accrued interest will be also be recognized in the same manner. So we can also show that. We can also show that on 31st December 2017. We have already determined the amount. So we also record it the same way. So bond interest, we debit bond interest expense, debit bond interest, expense, again 40,000. Again 40,000. And then we credit now bond interest payable, or if it is cash, you credit cash. But if you have not paid, then this is how to record it. Bond interest, not expense now, but payable, because you have not paid. Liability. Bond interest payable, again 40,000. So that is to again recognize the accrued expense. This is to recognize the accrued. But if you pay this, now we'll have their cash or bank, depending on now where the money was paid. So that is the entry that is expected to be made. So you can go on until 31st December, now at the expiry period of the bond. Remember, this bond was issued in 2017. So if it is a 10-year bond, if it is the 10-year bond, then the expiry date of this bond, you'll add 10 years to 2017. So if you add 10 years to 2017, remember this bond was issued in January 2017. So the expiry period of this bond will be 31st December 2026. 31st December 2026. So if this is a bond which was issued at par value at the expiry date, now the amount that we are expecting to be paid in 31st December 2026 will be the same amount, which is 800,000. So we can also record that. So in 31st December 2026, when this bond will be maturing or at its expiry date, now we will debit the bonds payable, debit the bonds payable, with the same amount, the bonds payable with the same amount. So remember that this bond, its par value was 800,000. So that is what the investors will take back, 800,000, and then we credit cash, because now XYZ will be paying back the money to the investors. Cash 800,000. Cash 800,000. Now the reason for doing that is so you can put in bracket paid bonds at maturity. Paid bonds at maturity. So at the maturity period, the company will pay back the amount to the investors. Paid bonds at maturity. So those are the accounting entries that we are expected to make if you are issuing the bonds at par values. If you are issuing the bonds at par values. So unless there is any question, we can continue. Any question? Okay. Now, if there is no question, then we move to bonds issued at a discount or premium. Bonds issued at a discount or premium. Remember that we said that we have the face value or the par value of the bond, face value or the par value of the bond. So this is like our yardstick, the face value. So any bond that you are issuing below the face value, if you are issuing any bond below the face value, then it means that now in such a case, you will be issuing that bond at a discount. You will be issuing that bond at a discount. And any bond that is issued above the face value, then it means that now you will be issuing the bond at a premium. You'll be issuing the bond at a premium. So these are the three bond issues. You can issue the bond at its face value, or you can also issue it at a discount and at a premium. At a discount and at a premium. So I want us to look at the bonds issued at a discount, bonds issued at a discount or a premium. A discount or a premium. Now, in our illustration that we have just looked at for XYZ Limited, we assumed that the contractual or the stated interest rate paid on the bonds and the one that was paid in the market had got the same rate. Now, this rate applied to the face value, and we used it to determine the interest that is paid in a year. Now, the market interest rate is usually the rate that the investors demand for loaning of funds to the corporation. Remember, a bond is also like a loan. Now, when the contractual interest rate and the market rate are the same, when the contractual interest rate and the market rate are the same, then the bonds sell at the face value, as we have shown. The bonds sell at the face value as we have shown. However, sometimes you will find that the market interest rate usually changes on a daily basis because they are influenced by the type of the bond issued, the state of the economy, the current industry conditions, or even the company's performance. Now, as a result of that, you will find that the bonds will at times sell below or above the face value. And we have said that if the bond sell below the face value, then it means that you are issuing the bond at a discount. But if the bond sells above the face value, then it means that now you are selling your bond at a premium. So to illustrate this, now I want us to assume that we have investors, and these investors have one of the two options that I want us to look at. The first option is to purchase the bonds at a market interest of 10%. Is the bonds at market interest. That is the first case, a market interest of 10%. That is the first option. So number one. Then, option two, purchased bonds that have a contractual interest rate, of 8%. Purchase the bonds that have a contractual rate of 8%. That is option number two. Now, assuming also that these bonds have got equal risk, and the investors will select the 10% investment, the 10%, the first case. Now, to make these two investments equal, the investors will demand a rate of interest which is higher than the 8% contractual interest rate. But remember, they can't change the contractual interest rate. So what they can do is to pay less than the face value of the bonds. So by paying less for the bonds, then they can obtain the market rate of interest. They can obtain the market rate of interest. So in such a case, the bond will sell at a discount. So when you are paying less than the face value. Now, on the other hand, the market interest rate may be lower than the contractual interest rate. And in that case, investors will have to pay more than the face value for the bonds. So that is, if the market interest rate is 8% and maybe the contractual interest rate is 9%, then the issuer will require more funds from the investor, and in this case, the bond will sell at a premium. Now we can show that relationship. We can show that relationship just to give us an illustration. To assume that we are having a market interest rate, use MKT. Assume that we are having a market interest rate there. Then the condition here for bonds sell at okay. So we have different situations there. So we are assuming that now we have the face value here, assuming the market interest rate is 10%, and this is our face value now. So if you issue any bond here below the 10%, so assuming that you are issuing the bond there at 8%, so 8% is below the face value there. So in this case, now if it is below the 8% contractual, then you will need to pay more. You'll need to pay more, and therefore your bonds will be selling at a premium. Bonds will be selling at a premium. Then if now the market interest rate is 12%, so it means that now you pay less for the bond, so therefore your bond will sell at discount. That is what we were just trying to in there. Bond will be selling at a discount, because the amount that now the investors will pay, this 10% here, this is the face value. We are assuming that the contractual interest is 10%, so that is the face value. The face value. So these are the three conditions that we have. So if the contractual interest rate and the market interest rate is the same, then you sell the bond at the face value. But if you find that now the contractual rate is 10 and the market rate is lower, then you need to, the investor, you need to sell your bond at a higher value than the face value, and therefore your bonds will be selling at a premium. But if you sell your bonds below the face value, then you will be selling your bond at a discount. So that is the condition. Now, when you are issuing the bonds at a discount, then it means that now the results that will come from the company, the contract rate will fall below the prevailing market rate, and therefore the investors will buy the bonds only at a price that will yield the prevailing market rate on the investment. So maybe we can demonstrate this, the bond issuance at a discount. Now, assuming that on January 2015, assuming that on January 2015, we have ABC Limited issued 100,000 par value, 100,000 par value, 100,000 par value, 5-year life, 5-year life of 8% term bonds. 5-year, so that is the bond period, 5-year, 8%, 8% term bonds, 5-year, 8% term bonds, with interest payable in July 1st and January 1st. Interest payable in July 1st and January 1st. The market rate of interest for the company's bond is 10%. The market rate is 10%. That is the market. Market rate is 10%. Now, in exchange for the purchase price, the investors of these bonds obtain the right to receive 2 different cash inflows. The first right is to receive 100,000 at the end of the bond issue's 5-year life. So you receive the 100,000 at the end of the 5 years. Then the second right is to receive 4,000 interest, 4,000 interest, 4,000 interest, 4,000 interest at the end of each 6-month interest period throughout the 5-year life of the bond. At the end of each 6-month interest period throughout the life of the bond. So they have already worked the interest for us. This 4,000, it is arrived at by taking 8% of 100,000, then you multiply it by half. 8% of 100,000, then you multiply it by half. So already they have determined the interest to be paid. We are to determine the at which the bonds will be issued. We determine the price at which the bonds will be issued. I hope you have already downloaded the table that it is in that you have it. So we are told to determine the at which the bonds will be issued. Now to do this, so I'm just having solution. Now to determine the present value of the future cash flows, we have to calculate the present value of the future cash flows by discounting the amounts to be received at the effective rate of interest. And the rate of interest that we are going to use in our case will be the effective market rate of interest. Now, the difference between the maturity value of the bonds and the present value of the bonds is the discount. I repeat, the difference between the maturity value of the bonds and the present value of both the present value and the discount value as follows. So first of all, we have the maturity value of the bond. That one we are given. Maturity value of the bond. So our bond will still mature at 100,000. Remember, we have said that the difference between the maturity value and the present value is simply the discount that we will have. So after having this, the maturity value, then we need to get now the present value of the 100,000 that is due in 5 years. That is due in 5 years. Remember, the interest rate on this bond is paid semi-annually, meaning in 5 years, we will be having 10 periods. The interest rate is paid semi-annually. So it means that this bond, in 5 years' time, the interest rate will be calculated in 10 periods. So therefore, at 5%, at 5% period, like that. Now at 5% period, that is the semi-annual rate at 5% period. Now we need to get now the present value of we need to determine the present value of this 100,000 at this period. The market rate is 10%. The market rate of interest is 10%. So if we are paying this in half a year, it means that now we will be paying half of the 10%, half of the 10%, and that is 5%. That is how we have arrived at the 5% here. We have just divided the 10% by 2. So at this at this rate, now we can be able to get the value of the 100,000 by taking the 100,000, and then from the table that you have there, we'll multiply now this by uh, PVIF, present value interest factor. Remember the period, we have 10 periods. Now the interest, which is 5%. So you can check this from the table, what this will give us. Check that from the table. Hope checking. Now, if you check from your table, for us not to waste time, you'll confirm later. This will be 0.6139. 0.6139. So if you multiply the 0.6139 by 100,000, that will give you 3 in 5 years time. So what?
Hello, kuna mtu anasikia Alec? Mimi sisikiki.
Hello. I hope you can hear me now. Sorry for that. Somebody tried to call me. Hello. Okay, I think we can continue. I was saying that if you check from your table, the PVIF 5%, that will give you 0.6139. And if we multiply this by 100,000, then this will give us 61,390. 61,390. Then we also need to get the present value of 4,000 shillings received semi-annually for 10 periods. So we can also note that the present value, the PV, let me write it as PV of 4,000 shillings. Present value of 4,000 shillings received semi-annually for 10 periods. So again, 10 periods, remember, is 5 years. And not 10 years, but 10 periods. So we also need to calculate that. So at discount, now again, it is also discounted at 5%. So this will be 4,000 times again PV IF in 5%. Now this one here, if you check from the table, that will be If you check from the table, that will give you, let me check. From the that will be 7.7 7.727. Sorry, not 27, but 7.7217, and we are multiplying this by 4,000. So you multiply this by 4,000. That will give you 38. Not 38, but if you multiply that, 30,887. 30,887. Now, that is now the disc for the 10 periods. This is what is supposed to be paid. Now, to get the present value of the bonds, we'll now add the 61,390 plus 30,887. That will be 7 there, 7,229. So 92, 92, 277. Now the 92, 277 is now the present value, the PV of the bond which is now our issue price. Issue price. Remember, this bond is issued at a discount. That's why you find that now the amount that the investor is paying, the 92,277, if you compare it with now the face value, which is 100,000, then you find that the amount that is paid is less than the face value. So to get the discount on the bond, we will simply subtract 92,277 from 100,000. So if you subtract that, you get 7,723. So 7,720. This is now, that is now our the discount on the bond payable. The discount on bond payable The discount on bond payable. On the body.
That's true.
Hello, yes, Mose. Hello.
Yes.
Hello, Doris. Hello. Okay, so the discount on the bond payable is 7,723. So that is the bond that is issued at a discount. Now remember, the interest is paid semi-annually. So the interest that we are using here, what we have done is that we have just taken the 10%, the one for the year, and then we have multiplied it by 6 out of 12. That is how we've got the, if you multiply this, you get 5%. Then for the periods, the period we had 5 years. 5 years. Remember that now the interest is paid semi-annually. So it means that now we will have 5 years times 2. That is what is giving us 10 periods. 10 periods. So that is how to go about it. If a bond is issued at a premium, we will also follow the same procedure, but you'll find that now the issue price here, the amount here will be more than the face value, but we use the same concept. So I don't think we have to look at that. In the notes that I've provided, there is an example there, but you follow the same steps that we have here. So I would like us now to move to our discussion forum so that we look at the problem there. Let's move to our discussion forum. And please make sure you participate. Make sure you participate in the discussion forum.